A company most people have never heard of designed the blueprints inside roughly 99% of premium smartphones on Earth. Over 350 billion chips shipped, yet they don't manufacture a single one. Keeping a 97.5% gross margin, they operate way more like a toll booth than a tech company. But here's the twist for this explainer. It trades at a trailing PE over 330, and literally today, July 14, 2026, HSBC downgraded the stock to a hold, calling it flat out expensive. So let's dive right into the ultimate semiconductor paradox. Section 1, the 97% margin. ARM Holdings is essentially the architect of the digital world. This single company designed the blueprints inside 99% of all premium smartphones globally. That level of market dominance is practically unheard of, and they pulled this off because their instruction sets were built from day one for extreme power efficiency. Back when smartphones were just taking off, battery life was the absolute deal breaker. That created a massive architectural moat that legacy PC chip makers like Intel just couldn't cross. And that smartphone dominance? It snowballed. It translates to over 350 billion chips shipped cumulatively across the planet. Because as everything around us became digitized, ARM's ultra-efficient designs scaled perfectly. We're talking everything from those tiny IoT sensors on factory floors to the processors running your car's dashboard, all the way up to massive servers powering the cloud. ARM's architecture is literally the foundational layer of global compute today. Now, here's where it gets crazy for numbers-driven investors. Because they only sell the blueprints and the IP, they operated with a jaw-dropping 97.9% GAAP gross margin recently. Let that sink in for a second. Physical chip makers like TSMC or Intel have to drop tens of billions of dollars just to stand up one single fabrication plant. ARM, they don't even touch the physical silicon. They let their partners eat all that massive capital expenditure and manufacturing risk. So ARM just sits back and generates software-like margins on hardware products. But right here is the dynamic we really need to unpack. Even with that flawless margin profile, today, July 14th, 2026, HSBC downgraded the stock to a hold. Sure, the stock surged about 93% over the past year, but that massive enthusiasm pushed it to a trailing PE ratio over 330 and a forward PE of around 130. To put that into perspective, a multiple that high means years, maybe a decade, of absolute, flawless, aggressive growth is already baked in. The HSBC note basically hit the nail on the head. The valuation has simply sprinted way ahead of the underlying financial fundamentals. Which brings us to Section 2, Blueprints and Toll Booths. To really grasp how a company gets priced for perfection, think of ARM as an elite architect. They sell the intellectual property, the architectural blueprints and instruction sets, to builders like Apple, NVIDIA, Samsung, and Qualcomm. But the secret sauce is the developer ecosystem flywheel. Software written specifically for ARM doesn't just natively run on rival architectures like x86 or RISC-V. No way. You'd have to heavily re-engineer millions of lines of foundational code. It creates an incredibly sticky switching cost that effectively locks the entire industry into the ARM ecosystem. And this breaks down beautifully on the balance sheet. For fiscal year 2026, out of $4.92 billion in total revenue, roughly 47% came from upfront licensing. So companies pay a massive chunk of change just for the right to use the blueprints. The other 53%? That's the royalty revenue. That is the literal toll booth. It's a small recurring fee collected on every single one of those billions of chips shipped. As long as device makers keep selling products, ARM keeps collecting tolls. It's a highly predictable, incredibly asset-light money machine. All right, Section 3, the AGI Silicon Pivot. So ARM already holds about a 50% market share of CPU compute among the major cloud hyperscalers. Think AWS Graviton, Google Axion, Microsoft Cobalt, NVIDIA Vera. They've aggressively pushed into the data center space because their power-efficient designs are exactly what's needed to manage the insane energy and thermal demands of AI. And from an investing standpoint, this matters immensely. Why? Because data center chips command vastly higher royalty rates than the standard smartphone chips ARM built its empire on. But then came the massive March 2026 plot twist. Listen to this, straight from their Q4 shareholder letter. We introduced the ARM AGI CPU, our first production silicon product purpose-built for agentic AI. Meta is our lead partner and co-developer. Think about that. ARM isn't just selling blueprints anymore. For the first time ever, they are partnering to build actual physical production silicon to go after a $15 billion data center opportunity. And this is the paradox.
ARM is actively choosing to leave the absolute safety of their high-margin, zero-manufacturing risk IP licensing model. They're stepping directly into the ring to fight x86 incumbents like Intel and AMD for actual physical silicon dollars. Sure, the revenue upside is way higher, but it introduces very real execution risk that they've never, ever had to deal with before. It's a textbook high-risk, high-reward pivot. Understanding why they're complicating a nearly perfect margin profile is honestly the key to analyzing this entire stock right now.
Let's look at the numbers in Section 4, the financial rocket ship. The financial momentum here is wild. In fiscal year 2026, total revenue hit $4.92 billion. That's a 23% jump year over year. Q4 alone brought in $1.49 billion. This is their third consecutive year of over 20% growth since the 2023 IPO. But honestly, the most crucial metric right now is their balance sheet. They are sitting on roughly $3.1 billion in pure cash and operating essentially debt-free. That cash position, that's the exact war chest they need to actually fund this expensive AGI silicon pivot without being forced to immediately tap into debt markets. Now here is the financial truth that really gets institutional buyers fired up. Their non-GAAP free cash flow absolutely rocketed from a modest $99 million in fiscal 2025 all the way to $882 million in fiscal 2026. Guys, that's a 791% increase in just a single year. It perfectly proves the extreme operating leverage of this toll booth model. When those high-value AI data center licensing deals actually hit the books, that revenue falls almost straight to the bottom line, simply because the marginal cost to license out existing IP is virtually zero. Moving to Section 5, priced for perfection. We have a serious cocktail of converging risks here that demand some strict analytical discipline. First, the elephant in the room, that extreme valuation. A trailing PE over 330 means there is literally zero margin of safety. Then you've got ARM China. This is a separately operated, independent entity acting as their sole licensor in China. It's practically a geopolitical black box that neither ARM nor SoftBank fully controls. Third is the open source threat of RISC-V. If ARM gets too greedy and raises its tolls too much, RISC-V is sitting right there as a completely free, royalty-free architectural alternative. Plus, SoftBank still owns roughly 90% of the outstanding shares. That incredibly low float means a tiny amount of buying or selling can cause massive, erratic swings in the stock price. And finally, that execution risk. To launch their new AGI CPU, they are now totally reliant on scarce physical foundry capacity that they don't even control. So when you have a near-monopoly architect trying to suddenly become a physical builder right in the middle of an AI supercycle, all while trading at a mind-bending 330 times earnings, you have to look really closely at the math. With the stock already up over 90% in a year, even after factoring in today's downgrade-driven dip, is a decade of absolutely flawless execution already fully baked into the price? It is an undeniably brilliant business model, but as an investor, you have to ask yourself, are you investing in future innovation, or are you just paying an incredibly expensive toll today?